Good morning and welcome to Financial Strategies with Scott Wardell. While various products may be discussed during the course of this program, please note that these discussions are intended only to educate you about financial topics. They are broad in scope and do not consider your individual personal financial situation. You should work with a qualified financial professional in collaboration with your attorney and tax advisor before implementing any financial decisions which will affect your personal financial situation. Thrivent financial representatives cannot provide legal or tax advice. Your local Thrivent representatives are Wayne Grunkley and Alan Sogstead, 215 Atlantic Avenue, Morris. Call 589-1731. And now, Financial Strategies with Scott Wardell.
Mike Barrett is not affiliated with or endorsed by Thrivent Financial for Lutherans. The views expressed in this presentation by Mike are his own. They're not necessarily of Thrivent Financial or its affiliates. The material presented has been obtained from sources we believe to be reliable and is current. Welcome into this week's edition of Financial Strategies with Scott Wardell. Scott, and again, guest Mike Barrett. Welcome into both of you.
Well, it's great to be here, Steph. And boy, I'll tell you, Christmas really has snuck up on us here. So I don't know about you, but I'm not ready at all. How are you doing?
I think I have most of my shopping done, but mentally, without the snow, it's really hard for me to kind of prep, I think.
Right, exactly. Especially the last 5 years, we've had so much snow. It seemed like winter long before we actually had Christmas. And this year, it just doesn't seem like it's going to arrive.
I've actually heard about 1 in every 4 we have around Christmas, so we're overdue.
Yeah, absolutely.
Well, Scott, before we get started, before we get to meet Mike, we usually like to let our listeners know about what's going on in the market. Some wild swings lately if they are invested. What should they do to help insulate themselves from that volatility?
Well, I know we sound a little bit like a broken record here when we talk about what's going on with the market and what the advice is, but I'm going to just bring us back for a moment, Steph, on last week, because last week, of course, the Eurozone leaders had reached an agreement and the market was up substantially on Friday. And I was talking about, well, what usually happens is that over the weekend, people start to really think about, well, how much of an agreement is this, or how big is the impact? And then they start to find holes in it. Well, that's pretty much what happened, So we were talking last week about the fact that don't be surprised if we get some volatility this next week, and we are in that period of time around the holidays where we sometimes get some thin trading because even traders go on vacation about this time of year. So, what happened this week is the market was actually down about 2.6% by the time the Friday close came. And I'm not trying to outguess the market, by the way. I'm just trying to give people little pieces of education where they can say, why is the market acting the way it's acting? And I always say, well, pretend that you're babysitting a 5-year-old that tends to, they might tend to overreact to different things. And last week they saw a little good news and they overreacted to the positive, and then they had a weekend to think about it, and then it got a little crazy on the other side this week. So, I'm not saying for sure this is going to happen, but this next week, after you get this kind of a sell-off, barring any other really bad news, there's going to be some people, I suspect, they're going to say, gosh, it got cheap again. And when it gets cheap again, we get a few more buyers. Now, again, that's barring any bad news, of which we've, had a plethora of it. But your question, Steph, is really about what should people do, because the markets have been just exceedingly volatile this year. And because of the way the format that trading happens, we're going to be in for this kind of volatility, I think, for a very long time. So, first of all, how can volatility be your friend? Well, if you're a long-term investor and you're investing in things like a 401k or an IRA where your contribution is going in consistently every month, you might actually benefit by some of this volatility, or I should say from some of this volatility, because the way dollar cost averaging works is as your contribution goes in, the swings of one week or the other will naturally get you more shares when the price is down and fewer shares when the price is up. And that could work to your advantage as long as it doesn't continue, down over a long period of time. Yeah. So that can be helpful. But one of the main ingredients as people are approaching retirement, they face a certain dilemma. And that dilemma is they mostly know, not everybody knows this, but they mostly know that they're going to be retired for a fairly long period of time, which means they need some growth in the portfolio, and they don't like the volatility that goes along with that growth. So there are some ways that people can put defense into their portfolio without completely shutting down some of their growth, the growth properties of their investment. And what they really need to do is sit down with a financial professional and have that discussion. And there are some methods that can be used today that, frankly, I've been in the business. This is my 30th year, and there are some methods that you can use that weren't available at all 20 years ago, and a little less traditional than, well, just move it all into more conservative income-producing investments. There are other ways, and so and you can transfer some of your risk, and there's it's really a discussion with a financial advisor to figure out what's the best way for any individual to do that. But I highly, highly encourage people to have that discussion because, frankly, there are a lot of folks out there that can't afford to go backwards, but they need the growth. And that's a tough dilemma, but it's not a dilemma with, without some answers. Not all perfect answers, but there's some strategies that I think can work pretty well there. So that's kind of my piece on the markets, but I am really excited to have Mike Bear with us here today. Mike is a CPA, and he is a good friend of mine, and this is a time of year, Mike, when we like to do some tax planning discussion. I appreciate you being here and providing this kind of advice and education to our clients. I had a guy on the show here about 5-6 weeks ago who always said Halloween is the time to do tax planning, and I think you'd probably agree with that because there's a lot of stuff that you can do at that time.
Yeah, I like that. I think that makes life a little easier on a CPA, I think, too, if you start planning a little bit earlier like that.
Exactly. And you've been in accounting for 22 years, so you've seen plenty of these strategies in play, and I'm sure that you've advised a lot of people to do these along the way. But before we get into really all those different strategies that could potentially reduce your tax bill, and I think people are really going to benefit from some of these things today. Let's talk about why someone might want to take advantage of these things, especially this time of the year. Why would someone be looking at this? I mean, there's the obvious answer, but why else?
Yeah, you're right, Scott. I mean, tax planning can be done before year end to really help your current year tax situation,
right?
And also to plan ahead for future years. Trying to just file your tax returns and pay whatever it comes out. I mean, that's not a good plan.
It's pretty passive.
Yeah, and you can be, the results can be uncertain. You can be very unhappy with the balance due you might have, where you would have put some thought into it, planned a little bit for what you were doing, reduce your current year tax balance at the time taxes are due.
Yeah.
There's a number of other reasons. I mean, you could run into a penalty situation if you haven't paid in enough tax during the year in the form of withholding or quarterly estimated tax payments that some people are required to pay.
So you might be able to do some things now to affect the income that might actually help you avoid a penalty if you've got it on your radar.
Right. Yep. So that's one plan of attack would be to attack the income side of things. Some income is controllable.
Right.
If you're retired, you have distributions you could take from an IRA account.
Right.
You can control those distributions.
Yeah.
And then, most of the time we're doing planning, we're trying to delay taxation.
Yep.
So we're trying to delay taking income as long as we can, and wait to pay tax to a later time.
Sure.
That makes sense. But at other times it can make sense to actually create some income or bring income into a year to maximize some of the lower tax brackets, let's say.
Right.
Where that can be a smart decision, as opposed to taking it later when it could be subject to a higher tax rate.
Absolutely. And I know we're going to talk a little bit about Roth conversions here in just a minute, but one of the things that I think about is I was working with a retiree here, last year, and in the previous year, he was in a 0% tax bracket. So we worked with his accountant to figure out, how much more can he make and still stay in that 0% tax bracket, and then kind of worked in the potential for him for some Roth IRA conversions, to take advantage of that, kind of frankly, turning lemons into lemonade a little bit there, because when you're in a 0% tax bracket, that usually means something isn't going quite right.
Yeah, no, that's a great example there, Scott. Yeah, that 0% tax bracket. You want to make sure you fill that one out for sure.
Right.
And then there is a 10% tax bracket now too. So
Yeah.
I mean,
Yeah.
that's a good one. The 15% bracket isn't so bad either when you start comparing it to the 25% bracket or
That's
or
right.
higher.
That's
So,
right.
yeah, it can, especially for retirees. There can be a lot of planning there where we are encouraging people to take more than just their required minimum distribution.
Right.
There can be years where you want to bring that in. Of course, an important thing to factor in there is the taxability of your Social Security benefits.
Yeah.
And how your other income sources will affect that. So you do have to take that into consideration. But yeah, let's at least fill out that 0% tax bracket.
Right. And I think one of the key messages that you just gave here a minute ago is just really know where you're at. Don't just take it for granted that that tax bill is going to be what it is, and there's very, very little that you can do about it.
Yeah, I think the first step, Scott, is just understanding your tax situation. So
Yep.
pull out last year's tax return, take a look at it, see what did you have on there for income, what did you have on there for deductions,
Yep.
how many exemptions did you have, what tax rate were you actually being taxed at. Just get kind of an understanding of that. Compare that to what you know for this year you've already had, what income you've already had this year, what deductions do you know about.
Yep.
And from there you can start thinking about other types of income you may have, other deductions that might be possible.
Yep. And one of the things that's happened through basically the recession is people's incomes have fluctuated a lot. They haven't been all that terribly steady, and to that point then when you have a fluctuating income, then there is sometimes a way to maybe draw a little bit more into a low year, and especially if you can see that next year it might be a little bit higher.
Yep, you're absolutely right. That's a great strategy. Kind of pushing things into one year versus another. Same thing on the deduction side.
Yep.
Sometimes you may not have enough deductions to itemize in a year.
Yeah. Yep. Exactly.
So what you could
bunch
do
'em
there,
up.
yeah, maybe instead of making charitable donations this year, wait till the first of next year
Right.
to do what you would do.
And maybe double up,
Yep.
yeah, so that you actually get the deduction. Because I know I see exactly what you're talking about there when I am doing financial planning for folks. Because oftentimes you'll look at it and say, "Gosh, year after year, you're not getting you can't itemize your deductions." They may have lost their mortgage payment because good news is they paid it off, and the charitable contributions aren't making it up. But if they can bunch them up, and put 2 years into 1 year, of course, it's if you have a charity that depends on that contribution, you might have a conversation with them and say, "Hey, here's what I'm up to. That's why you didn't get so much this year, and you're going to get more next year," and they can maybe even it out over time. So
yeah, not to be a Scrooge this time of year, or not make your charitable donations, but yeah,
right,
kind of arrange it to maybe work better.
Well, in an easy one, Mike, I mean, people who file quarterly estimates, and if they're worried about their federal tax return and they might be a little bit behind on their estimates, can always accelerate that Minnesota estimate in the last quarter as long as they pay it before the end of the year, right?
Yeah, let's go over that just real quickly, just as a refresher for people.
Okay.
But you are required to pay in tax throughout the year.
Yeah.
So people, wage earners generally have withholding that's being taken out throughout the year.
Yep.
And other types of income, whether that's investment income, retirement income, might not have withholding. So in that case, you're still required to pay in tax throughout the year.
Yeah.
But what's available to take care of that are quarterly estimated tax payments.
Yeah.
So for an individual filer, your first quarter is due April 15th, then June 15th, September 15th, and then January 15th.
Right.
Is when that fourth quarter one is due. So that's the one that'll be coming up here.
Right.
A smart thing that can be done, a real simple thing, would be if you know you're going to have some state income taxes due.
Right.
You may want to try to pay all of that in with that fourth quarter payment and make that a little bit early. Make it by December 31st, write the check out and get that mailed out. That way that state taxes paid is going to be deductible on your federal tax return if you're able to itemize your taxes.
Absolutely. Yeah, because if you wait the regular 15 days and do it January the 15th, then it goes on the next year as a deduction. So, yeah, I know a lot of people that take advantage. I've taken advantage of it several times myself and just said, hey, let's get that in the mail December 30th or 31st. Get it postmarked. Yeah.
One thing to watch here, just AMT tax. Look out for that.
Okay, alternative minimum tax. You bet.
We're talking about taxes on Financial Strategies with Scott Wardell. Thanks for joining us this week. We'll be right back.
How would your financial life improve if you changed just one thing? Avoid ATM fees, make your gifts rather than buy them, protect yourself from identity theft, save more for your family's future. The list goes on. If you heard something today on Financial Strategies that motivates you to change one thing in your life, Thrivent Financial for Lutherans has free tips and resources you can use to do one thing differently. Find more at thrivent.com/one thing. Think about your finances, your lifestyle, your wants versus your needs. What one thing can you change today and see the impact tomorrow? Perhaps your family will save all your change for a month and donate it to charity. Maybe you'll finally write a will. Whether you choose to start simple or take a big step, that one thing can really make a difference. If you heard something today on Financial Strategies that motivates you to change one thing in your financial life, Thrivent Financial for Lutherans has free tips and resources you can use to do one thing differently. Find more at thrivent.com/one thing.
Welcome back to Financial Strategies with Scott Wardell. We appreciate you joining us this week. Our guest in studio is Mike Barrett. We're talking a little bit about end-of-the-year taxes. But before we get back into it, Scott, we always have a special deal of the week.
We do, and because we're talking taxes today, I'm pretty excited about this one. And, we've had some pretty generous offers here in the last couple of weeks, and we got another one this week because this is a book called Lower Your Taxes, and the author puts in parentheses, big time. So Lower Your Taxes Big Time by Sandy Botkin, CPA. You can check this out online, but I think it's pretty close to a $20 book, $17, $19 book, and we're going to give it away free today for the people who call in. And of course, they have to call that number. I'm going to give it to you right now. It is it's a toll-free number, 1-855-346-4332. And all you have to do when you get the recording is give your name, your address, and your phone number, and then we will send that book out to you probably by the end of the week. And, let's, in the spirit of us being sharing, if you called in to get last week's book, then I'm going to ask you to refrain from calling this week. Let somebody else have a chance. We're going to go up to 50 copies of this book. And I believe that in our listening area, that's going to cover most of our calls. It might not cover every single one, but it should cover most of them. It is called Lower Your Taxes Big Time by Sandy Botkin, CPA. And just give us a call. Again, the number is 1-855-346-4332. We've got Mike Barrett on with us, CPA. And Mike, thanks again for joining us. And we've been talking about a few things that you can do to still reduce your tax bill for 2011. As you know, many people who are covered by 401ks, they still have the ability to increase that. Let's talk about 401ks and also HSAs, health savings accounts, and how they still might be a benefit to someone between now and the end of the year. How are they going to do it?
Yeah, good point there, Scott. 401ks, anything further you can do for as far as an elective deferral out of your paycheck to put into a 401k is going to reduce your taxable income for the rest of 2011. Some people might be fortunate enough to get a bonus at the end of the year.
Sure.
If that's the case, that would be a perfect source of income to what you would call shelter from tax.
By putting the majority of it into, or maybe a catch-up into a 401k or an HSA or something.
Yep, exactly. Yeah, well, the 401k would be, what you could actually make an elective deferral, designate part of that to go right into your 401k account and not be taxed to you on your W-2 when you get your 2011 W-2.
And most companies, people think that they can only make a change in their 401k contribution during open enrollment. but almost all companies that I work with will actually allow people to make an election like the week before. And so let's say that you're behind on your 401k contribution. You might say, I want 50% of my next check to go in, or 100% if you still have that much room.
Yeah, that's a good point. You should double check with your employer and make sure that their plan would allow you to change it. But yeah, if you're able to get your elected deferrals closer to the maximum amount for the year, which would be I think it's 16,500
Yes.
for this year,
Mhm.
and then if you're age 50 or older, you could add another 5,500
Right.
to that, I believe. So that
One of the advantages of being older.
yeah, there's a few things you run into every once in a while that is an advantage for growing old. So
And the HSAs, we can really take those HSAs and make those elective deferrals for a little bit longer. We don't have to worry so much about the end of the year on that, don't we?
yeah, the HSA, that's a health savings account. So you do have the ability to make a contribution to your HSA for 2011 all the way up until the due date of your tax return on April 15th. So you have time to still make a contribution to that account. However, if you don't have an account set up already and are covered by a qualifying high deductible insurance,
Right.
You won't be able to do that for 2011. So now would be the time to start planning for 2012 if you were interested in that.
Exactly. And a lot more people have HSAs than in the past, those health savings accounts. So
Yeah, I have one. Seems to work great, and
yep.
I think they're good plans. I mean, it makes you a lot more conscientious of what you're spending your healthcare dollars on too.
It's kind of the whole idea, frankly.
Yep.
Okay. Another one, Mike. Tell us a little bit about Roth conversions, and can someone still execute this thing before the end of the year, and what why might they want to do something like that?
Sure. Yeah, Roth conversion, as you know, Scott, that's not going to save you any tax dollars off your 2011 tax bill.
Right.
That's not the concept. The concept there would be to potentially grow your retirement assets into a larger sum by the time you would be drawing them out.
Right.
And how that would work, and maybe you can describe a little bit about this, Scott, but what's going to happen that the dollars that are invested are going to grow tax-free, and that's the beauty of the Roth account.
Absolutely. And so, back to our first discussion here about people who might be in that spot where they've, at the end of the year now, they can have a view of where their income is coming in. And if they say, gosh, my income is actually down a little bit, I might be in a lower tax bracket, they can call their accountant, they can do a rough estimate, find out what bracket they're in, and maybe still execute a Roth conversion, and and I say a partial Roth conversion, because a lot of people have fairly large sums and 401ks and IRAs and different kinds of qualified accounts, and then put it in the account and actually choose to pay tax on those dollars in this tax year, 2011.
That's right. Yeah, by making a Roth conversion, in effect, what you're doing is making a taxable distribution from an IRA or 401k.
Right.
So you do need to understand that. I mean, it's been a hot topic, and a lot of people think, hey, let's make a Roth conversion. Well, you got to understand it could have some significant tax impact in your current year.
Right.
But like you're saying, there's situations where you might have, say, a business loss in a year. You might have very low other income in a particular year. Those are perfect situations to intentionally, again, create income,
Yep.
to fill out some of those lower brackets, have minimal tax effect, and then have those assets sitting in an account where in later years you're going to be in higher tax brackets, sheltering that money from income tax.
Absolutely. And of course, a lot of retirees have said to me that I've met with, well, I didn't know I could have a Roth. And of course, we described to them there's a huge difference between Roth contribution and Roth conversion. So a lot of those folks that, because they have no more earned income, are not eligible for contribution, are very eligible for conversion of some of those other qualified dollars.
Yep, that's exactly right, Scott. And again, let's remember the beauty of this Roth. Down the road, you take those distributions from that Roth. How much income tax do you pay on that, Scott?
Zero.
Pretty nice.
Yep, we're always worried that someday they may take that away from us because it's pretty sweet.
Let's hope that doesn't change.
Exactly.
So Mike, tell us a little bit about year-end tax selling for both gains and losses, how investors can maybe take advantage of that between now and the end of 2011.
Yeah, that's one good thing to do is to take a look at your portfolio, see if you've had if you're holding any stocks, mutual funds, and let's say you've sold some things at a gain during the year.
Sure.
This would be the time to maybe look at your portfolio, see if you have any unrealized losses that you could use to offset those gains.
Absolutely.
In addition, if your losses exceed your gains, you can deduct an additional $3,000 against ordinary income tax or ordinary income.
Yeah.
So that's more valuable than just saving at the capital gain rate, which is maxed at 15% right now. You could actually save at your ordinary tax rate, which could be higher.
Right. Very good. And of course, the thing is that capital gains are kind of a hot topic right now because of the possible expiration of the Bush tax cuts. Because, as you know, Mike, the Bush tax cuts got extended for 2 years, which takes them through the end of 2012. And there's a lot of speculation that possibly they might want to mess with them during the year 2012. But if they just let them expire at their scheduled time, it'll be the end of 2012, the year that we're headed into. So that means that right now in 2011, you're going to pay tax at a 15% tax rate on your capital gains. The rate will, after 2012, if they don't extend or modify them or do something else, will go to 20%. After that, they might actually want to hike that up because everybody knows the government needs, some money, and so if you're sitting on, and I'm working with some folks right now that are sitting on some very large positions in their portfolio where they have a lot of gains, and frankly, they want to spread those gains out over 2 years. We're trying to get them spread out, over 2011 and 2012. And we're taking a little chance with 2012, but boy, I think if you are waiting much beyond that, your chance is really kind of risky, frankly, because right now, at least if things just go as they're planned, those Bush tax cuts will expire at the end of next year.
Yep, that's right. And don't just think solely in terms of maybe your stock portfolio. These long-term capital gains rates, they apply to a lot of other types of holdings. So you might have land
right.
that you're holding and might be looking to sell.
Basically any appreciated asset.
Yep, you may have a business that you would be selling. So keep in mind that those long-term capital gains rates, which are very friendly right now at 15%, they may not be there if a transaction doesn't happen until after 2012.
Right, and I don't know if they've ever been lower. I think 15% is kind of a record low, if I'm not mistaken. Of course, that history is a long time, but
at least in my lifetime.
Right, exactly. Well, Mike, let's move for a moment into charitable deductions. And when we've talked about charitable giving in the past, let's just talk about it from a tax point of view a little bit here. They can obviously be made in stock or cash or property for that matter. But what's the advantage of doing them this year versus next year?
Well, it's pretty simple. The advantage is you're getting the deduction this year versus next year. So your taxes for 2011 are going to be due April 15th. You're going to have to pay whatever that balance is.
Right.
Why not make that balance lower this year versus next year? And you can do that as simply, by simply getting your checks out to your favorite charities, your church, whatever, by the end of the year here.
Absolutely. And of course, if they choose to give stock, and we'll talk a little bit about that as we go forward here, but they can also find if they got some appreciated stock and use that as a deduction if they give the stock and transfer it before the end of the year as well.
That's a very valuable piece of the tax code that most people don't take advantage of. If you are in a situation where you are holding stock that has appreciated, normally when you would sell that, you would be taxed on the capital gain. You would pay the tax on that, and then let's say the proceeds from that could turn around make a donation to charity,
Right.
and get a deduction for that amount. Well, the beauty of what you're talking about, Scott, is you could actually just donate the appreciated stock, get a deduction for the full amount of the value, the fair market value of that stock,
Right.
and that stock, the gain
And ignore
that
the
was
gain.
that unrealized gain that was sitting there doesn't get taxed.
Right.
It's really you talk about double taxation in some cases. This is really the opposite of that.
Yeah, you avoid the income, and you get the overall tax deduction.
Yep.
So yeah, I think it's a great way to do it. And if people were going to do that, they'd have to move fairly quickly on this one, frankly, because it does take a while to get some of these things transferred to charities. I've helped several clients with it, and we like to have a little. We can still do it, by the end of the year, but you got to have a little window of time to get all that paperwork done.
Yep. Yeah, and then just remember too, if you're holding all stocks that have declined in value.
Oh yeah, this is not for you.
That's not.
There you could do the opposite. You could sell the stock, take the deduction, and then take the proceeds and take the deduction on the gift.
You got it. That's
Yeah.
the way to do that.
Absolutely.
Well, let's pause for a moment here. Thanks for joining us this week. Financial Strategies with Scott Wardell. We'll tell you a little bit more about this taxable potential toward the end of 2011, what to do with your taxes, and recap that special offer for this week, too, coming up next.
Nearly 3 million members look to Thrivent Financial for Lutherans to help them achieve their financial goal. Nearly 3 million people know that Thrivent Financial is committed to excellence in financial services and caring for others. Get to know Thrivent Financial and the quality of products and services they can offer you. In Minnesota, you have a host of representatives to help you with your financial needs. Contact your local Thrivent representatives Wayne Grunkley and Alan Sogstead, 215 Atlantic Avenue, Morris. Call 589-1731 or call 1-855-346-4332. Registered representatives for securities offered through Thrivent Investment Management Incorporated, member FINRA and SIPC.
Welcome back to this week's edition of Financial Strategies with Scott Wardell, and our guest in studio today, CPA Mike Barrett. Mike is not affiliated with or endorsed by Thrivent Financial for Lutherans. The views expressed in the presentation by Mike are his own and not necessarily those of Thrivent Financial or its affiliates. The material presented has been obtained from sources we believe to be reliable and is current. With that, we always have a special offer each week. Scott, you just love to give stuff away.
I do love to give stuff away. It's really fun because, here we're on the show. We're trying to give people a good education. And, Mike, thanks again for being here. We really appreciate not only your expertise, but your years of experience that you bring to us here today and all these great ideas. For people who really want to do a little bit of their own education, today's free offer is a book called Lower Your Taxes Big Time by Sandy Botkin, CPA, and we're going to give that away free to people who call this number, 1-855-346-4332, and all they have to do is give us their name, their address, and their phone number, and we don't have a ton of the copies in stock. We're going to be ordering them up to 50. So we'll give away 50 of those books. That should cover most of the listing areas. And if it's not, we'll certainly get back to you and let you know. But most of the people that call in, if not all, will be able to get a free copy of that book. I think it'd be a great reference. And really, tax planning is something people need to familiarize themselves more with. I know that when I review with people a little bit of what tax bracket they're in, and even looking at what their adjusted gross income is, a lot of them really are kind of clueless, frankly, and I'm sure you find this. It's not their occupation. It's not what they tend to know, and so they're a little bit at a loss, and sometimes they feel like they're at the mercy of how the whole tax process goes. So this would be a good book for them to call that number. I'll give it to you one more time. It's a toll-free number, 1-855-346-4332. Call in, and we'll send you a copy of that free book. And Mike, right before our break here, we were talking a little bit about donations and charitable contributions, and you were walking us through a little bit about if you were to give stock. But there's another way for retirees to make a charitable contribution, because still in 2011, they can actually give distributions from their RMD. And retirees, you know what I'm talking about, required minimum distribution, directly to that charity. So walk us through how that works, Mike, because this is kind of a special deal too.
It is. It's and this one ends at at the end of 2011, unless it gets added back. So very important if you're thinking of doing this. Get on the horn with your financial advisor. Get going on this one too. The beauty of this is you're able to take that required minimum distribution, dollars you're going to have to take out of your IRA, which are going to be taxable. Instead of making that taxable, we can distribute that right to a charity. You won't be getting a charitable contribution deduction, but you'll be excluding that amount from your taxable income.
Which for many people, that's better.
It's way better.
Okay.
Yeah. It's. Oh, sorry, I'm getting a little excited here about taxes.
Right.
That's one of those above the line
Right.
Items.
Right.
So that's going to reduce your adjusted gross income. As some of you may know, having a lower adjusted gross income is important in various parts of your tax return. So a lot of things are based on adjusted gross income. A lot of your deductions, credits can be phased out because of a higher adjusted gross income.
Yep.
By excluding this amount from your income right on the front page of your 1040, that's going to really enhance your tax savings.
Right, and so one of the most frustrating things for retirees is paying tax on their Social Security. And as you know, Mike, they can pay tax on up to 85% of their Social Security. And we're not saying that this by itself, because we don't know the individual listener here where they're at, but it could potentially take some tax off of their Social Security if they're in the right bracket and the right income, couldn't it?
That's right. Oh, that's a great point, Scott. Yeah, you could end up, your Social Security benefits could end up being non-taxable depending on your situation.
Yep.
So that combined with the lower AGI, let's say you don't have enough other itemized deductions either to even itemize.
Right.
Maybe you were going to, that charitable contribution wasn't going to be enough to even get you over the standard deduction amount because your house is paid off, you have no mortgage interest. There's another way that you got a benefit out of something you weren't going to get a deduction for.
Right, and then as you said, this is the last year. So now, Mike, not to put you on the spot here, but what if they've taken their RMD already and they've received it themselves? Can they still take that as a deduction, or is that a sketchy one? It has to be made direct to the charity?
I'm not sure, Scott. I think it does. I think that does have to be arranged to go directly there, but that's something they'd have to get details on. I guess I don't know.
Right. We could certainly look it up for them, right? You could look it up for them, or their accountant, or their financial professional. But most likely, it'd have to come straight out of the qualified plan, the IRA or the 401k, in order to do that.
Yeah. So if you're thinking of doing this, you should get in touch with your advisor right away.
Exactly.
So I know that many people actually like to do non-cash donations, something like clothes or food maybe. Tell us a bit about how that works and what the limitations might be.
Well, the way that works around my house is my lovely wife, Rochelle, usually encourages me to go through the closet, maybe make a little more room in there for maybe identify a few pieces of clothes I haven't worn for a year, 2 years, 3 years.
Sure.
That's how it starts,
but
and
not
then
your favorite shirt, Mike. Don't.
I might still wear that. I might still wear
like
that
this stuff. Seriously.
I'm not surprised.
Yeah. I mean, do you have one that's like completely worn out that you're like, I just would not part with this no matter what?
No.
It's a guy thing.
Yeah, it is a guy thing.
They're some of those older T-shirts. They're perfect for playing hockey or whatever.
Right.
Right. Well, on the other side of that, though,
yeah.
Once you go through the task of piling up a pile of clothes or other items, other things are a lot of furnishings in your house. Instead of throwing those out, filling up the landfills, there's plenty of people that your junk might be their treasure.
Right.
Those are valuable things. On the other side, you can also get a tax deduction for that. So that's the beauty of that. Now the laws have gotten a little more stringent on items that you're giving away. They need to be in good or better condition to be able to donate things. So my ratty old T-shirts I use for hockey, no sense giving those away, dear, because they don't qualify anyway. But,
right.
Anything that can be worn, you would want to make a list of those items, value them at thrift store value.
Sure.
So what they might sell at your neighborhood Goodwill, Salvation Army.
And how do you figure that out?
Well, the responsibility is on you. If you go, bring these items over or have them picked up at your house by the charity, they won't value those items for you. So you need to make a list and value them. A lot of these organizations do have guides, so they'll probably give you a list of, say, like a shirt maybe worth $2 to $5 an
sure.
item, or a pair of shoes might be. So they'll give you kind of guidelines you can use, but the responsibility really is on you. Make sure you do have support for this. Get a receipt from the charity, make a list of the items, value them. Another great way in this day and age is to take a digital picture of the items.
Sure.
That's good evidence of that you actually gave away this heap of clothes.
Right. So you don't have to take a picture of every single one of them necessarily.
No.
But
I mean,
but lay them out and take a picture of 6 or 7 at a shot or something like this.
Yeah, I think
with
that
digital
provides good
cameras, I
support.
mean, you're not wasting any film, but still, it could be a big file.
Yeah. Perfect times to do this. If you're moving, you may have a large amount of items. And it people always ask, well, how much can I do? How much can I donate? Well, there's not really a limit on that. There are limits as far as how you need to report it on your tax return.
Sure.
So if that value is up to $500 of non-cash items, you can simply just list that, the charity and the amount that you donated on your return. It's as simple as that. Keep your supporting documents. If your non-cash items total more than $500, then there is another form you need to fill out with your tax return. It provides more detail, dates when you donated, the address of the organization you donated to. A little more detail to provide is all.
Right. Now, you say there's no limits, but isn't there a 50% of AGI limit on charitable contributions overall? So, I mean, it's a lot, but...
You're right. There is a limit, but yeah, for practical purposes, we don't run into it too often for people, but yep, you're right. There is a limit.
Okay. So, Mike, let's talk about anything that might be expiring this year that people should pay attention to. So, usually, as the tax year moves on, we get some changes. And I'm sure that there's a couple of things that 2011 is probably the last year or where things get reduced. Walk us through that if you would.
Yep, you're right, Scott. Yeah, we are losing some stuff at the end of 2011. There's going to be bigger changes after 2012, like we talked about earlier.
Right, when the Bush tax cuts expire, if they don't go, get changed before that.
Yes,
right.
Yep. So we're going to have some real big changes then, but there are some significant items that are going to expire at the end of 2011. We talked about the charitable contribution from your IRA.
Yep.
So that's one that's going to end
going away. Yep.
A big one is the 100% bonus depreciation that's available for our business owners, farmers. What that is, that allows you to expense 100% of qualifying items. These would be new equipment or new furniture versus buying used things. But
instead of depreciating it over time, you just take the whole thing right now.
Yep, you have the ability to take advantage of that. Now, the bonus depreciation won't be going away, but what will be available will be 50% bonus depreciation in 2012. The other thing you have available that's been around for a long time now is the Section 179 expense deduction. So that's another way to expense equipment purchases versus depreciating them.
Right.
Right now in 2011, we have some extremely high limits on the amounts of equipment and qualifying purchases that you can choose to expense at Section 179. They're going to really be reduced in 2012. So right now you can expense up to $500,000 of Section 179 eligible purchases.
I don't know a lot of folks that can use that, but
I don't know. You have a $500,000 tractor that you've been eyeing at all?
No. I wish I were looking at that, but no. For me, it's the older used equipment.
Yeah, but it can, for people with that might own a business that has upgrade equipment needs. That can be very significant. We're still going to have some healthy limits for 2012. It's going to drop back down to the level it was before 2009, which was 125,000 for the maximum, but it will be indexed for inflation. So I think it's going to actually be 139,000 is the figure. I think
okay.
I've heard that.
Okay.
So you still don't get too panicked. If,
for most people, that's going to be more than enough.
Yeah, we don't know after 2012 what's going to happen
Right.
there. That could drop down significantly.
But, I've heard some stories about how expensive combines are these days, so there may be some listeners that are like, yeah, you say it doesn't affect me, but it just might.
Well, a few of you might have gotten a sales pitch from someone, telling you that some of these things are expiring.
Yep.
This is what they're talking about. I mean, these laws are changing, so
right.
And remember that bonus depreciation. The beauty there, Section 179 is going to have a lot of limits in some cases, and your taxable income might be one limit.
So it might be a little harder to use.
You might be able to get the bonus depreciation, or you wouldn't qualify for it. Section 179.
Okay.
We're talking taxes today on Financial Strategies with Scott Wardell, nearing the end of 2011. Up next, we'll recap some things for you, let you know, again, how all this kind of works into your financial plan, your retirement plan, and let you know, too, what that special offer is for this week. That's next on Financial Strategies with Scott Wardell.
How would your financial life improve if you changed just one thing? Avoid ATM fees, make your gifts rather than buy them, protect yourself from identity theft, save more for your family's future. The list goes on. If you heard something today on Financial Strategies that motivates you to change one thing in your life, Thrivent Financial for Lutherans has free tips and resources you can use to do one thing differently. Find more at thrivent.com/one thing. Think about your finances, your lifestyle, your wants versus your needs. What one thing can you change today and see the impact tomorrow? Perhaps your family will save all your change for a month and donate it to charity. Maybe you'll finally write a will. Whether you choose to start simple or take a big step, that one thing can really make a difference. If you heard something today on Financial Strategies that motivates you to change one thing in your financial life, Thrivent Financial for Lutherans has free tips and resources you can use to do one thing differently. Find more at thrivent.com/one thing.
Welcome back to this week's edition of Financial Strategies with Scott Wardell. We're talking taxes today with special guest CPA Mike Barrett in studio. And every week, Scott, you like to give away a special offer. What do you have this week?
Well, this week, of course, we're talking taxes, so we want to give a relevant tax offer here. And we're giving away a book. And the book is called Lower Your Taxes Big Time by Sandy Botkin, CPA. And all folks have to do to get a copy of that book, and we've got it available for the first 50 people that call. I think that's going to cover everybody who calls. I can't guarantee it because sometimes we could go over that, but the number to call is 1. It's a toll-free number, 855-346-4332. All you need to do is leave us your name and your address and your phone number, and we will get that book sent out to you, compliments of the show and of Thrivent Financial. So give a call if you're interested in getting a copy of that book here today. So, Mike, we were talking just a minute ago about some of the various expiring tax deductions, and I think you got a couple more important ones that you really wanted to make sure that we knew about.
Yeah, one real big one for people people have probably noticed in their paycheck this year has been the reduced Social Security tax that's taken out of your check. That right now you may be following on the news. There's kind of a battle in Congress to extend that for another year, or maybe even decrease that tax further. So normally 6.2% would be the Social Security rate that's taken out of your paycheck. Right now for 2011, it's 4.2%. One plan I heard is to bring that down to 3.1%.
Even lower than the 4.2.
And even lower than what it was this year. But
right now, it's going to automatically go up to 6.2. I think President Obama said he was going to make them stay there in Washington until he got this work done, but we'll see how that goes.
Yeah, so this is one that affects most people, and that net check might decrease unless that gets extended.
Okay.
That's an important one. The other thing that affects a lot of people is that darn AMT tax, alternative minimum tax.
Yeah.
There's an exemption amount you get in the calculation for determining if you're subject to alternative minimum tax, and it's been kind of the routine to it looks like it's going to expire, go
Right.
back down to the lower level. Everyone's panicked
Yeah.
that all kinds of people are going to be subject to alternative minimum tax.
Yep.
And then right at the end of the year, they bump it back
So
up.
right now it's scheduled to expire again?
Yeah, it's scheduled to drop. Well, not expire, but drop back down.
Oh, drop back
to
down.
levels. It's,
Yowzer.
yeah, that's one we really got to watch, because if they ever do not restore the higher limit,
Right.
there's going to be a lot of
A lot of
unhappy people.
Yeah. Okay.
So, Scott, how does all of this discussion about taxes work into what we've talked about all year long, investment plans or financial plans, and how could it affect retirement?
Well, the first thing, Steph, is I'm always want to be conscious that we're not letting the tail wag the dog. And what I mean by that is you can get so focused on taxes that you really start to forget about, frankly, some of the bigger issues like, how much do I have to put away in order to reach my retirement goal and some of these things. But having said all that, very frankly, we like to really look at people's overall investment portfolio and their retirement portfolio in 3 different buckets. Those buckets are tax now, and that's, of course, things like CDs and savings accounts and investments that they hold outside of an IRA or a 401k. The tax later, that, of course, is like your 401ks and your IRAs, because you're going to have to pay tax on that one sometime along the way. And then the tax never bucket. And, of course, that's like your Roth IRAs and a few other items like maybe the cash value of your life insurance and municipal bonds under certain circumstances can be in that tax never bucket. So it is an important part of somebody's financial plan and their investment plan, because let's face the facts is once you turn this stuff into income and you've got it flowing to you, you don't need as much income if you don't have to pay tax on it. So we try and pay a lot of attention. And, of course, we work with accountants like Mike to help get the best result for our clients. Because it really can, by reducing their taxes, can get a lot more money in their hands to do with it whatever it is that they want. So it's a big part.
So what are the considerations then for your investment selection for tax planning?
Well, you have to take some of the same considerations that you might use otherwise. First of all, risk tolerance is big. Your time frame is huge. Making sure you've got enough liquidity, that you've got good investment balance. You got to give consideration to also to how the money might be managed along the way, because some of these investments take a fair amount of management, and others, frankly, you can just kind of let them ride and not pay all that much attention to. So it's really the same overall. We just have to decide how much we want in each bucket and then manage it appropriately.
Now, in past weeks, we've talked about retirement income planning. Do you think that process and the tools that we've discussed can be used for tax planning too?
Absolutely. When we do retirement income planning, the very thing we're talking about is once we consider those income streams, we start to say, what bucket are we going to take the money out of? And when we have a lot of choices like tax now, tax later, tax never, we can sometimes blend them to get the best result. Or other times we say, hey, you've got other stuff going on this year, so let's take it from the tax never bucket as an example to offset maybe income from something else. So it gives us a ton of flexibility. And that is really one of the things we do, and why it's important to have your retirement plan really go through a navigation process every year, because things change. So, Mike, before we go here, I want you to say just a little bit about how life insurance is used in tax planning, because that's a tool that a lot of people are using, and it's not as thought of as much as Roth IRAs and some of the other choices.
Yeah, that your bucket approach is great, Scott. Like you say, you have the tax now, tax later, tax never.
Yeah.
Items. The life insurance, that's one of those things that can fit into all of that planning there. What we often see is life insurance used as a vehicle to allow your investments to grow tax-free.
Sure.
And maybe you can explain a little bit, Scott, how someone might be still able to access funds that are within a life insurance.
Right. Well, and there are some special rules about that. So it depends upon how you've actually funded that life insurance program. So I won't get into the details of something we call a modified endowment contract, but on the standard contract where you're not cashing it up real big, you can actually take some tax-free withdrawals from it, or you can take some loans from it. But that's not true of every contract, because if you've cashed it up in some fashion, you have changed the tax nature of that. But that's why we like to sit down with individuals and say, hey, let's take a look at your contract and how it's funded and how it might work in your situation. So, but yeah, there's some real opportunities there. And of course, a lot of people use it for their estate planning as well. So that's where we look for synergy. You can get some good income tax really relief, as well as some potentially relief to your overall estate if you use life insurance appropriately.
Yeah, it sounds like a topic for another show.
Yeah, it does. We can do a whole show on that.
I think so.
Okay.
So, Scott, what do you have in store for us next week?
Well, next week, of course, is Christmas Eve, and I've got a special show planned for us, frankly, Steph, and that is I want to really dissect one of America's classics, and that is Dickens' Christmas Carol, because our friend Ebenezer Scrooge teaches us an enormous amount about money. So, folks, I think you might be pleased if you're, on Saturday morning wrapping presents and the like, and you want to hear just a little bit more about A Christmas Carol and maybe how it might apply to you today. Tune in next Saturday. I'm looking forward to it.
All right, thanks, Scott. Scott Wardell and special guest CPA Mike Barrett in studio today. Thanks to both of you for coming on out. This is Financial Strategies with Scott Wardell, and you want to recap that phone number for the free gift one more time?
For the free gift is 1-855-346-4332. And, of course, the gift is a tax book. It's called Lower Your Taxes Big Time by Sandy Botkin, CPA. Call, and if you're in the first 50 people that call, we'll get you a free copy sent out.
That'll do it for all of us this week. Thanks for tuning in. See you next week.
We hope you've enjoyed the past hour of Financial Strategies with Scott Wardell. While various products may be discussed during the course of this program, please note that these discussions are intended only to educate you about financial topics. They are broad in scope and do not consider your individual personal financial situation. You should work with a qualified financial professional in collaboration with your attorney and tax advisor before implementing any financial decisions which will affect your personal financial situation. Thrivent financial representatives cannot provide legal or tax advice. Your local Thrivent representatives are Wayne Grunkley and Alan Sogstead, 215 Atlantic Avenue, Morris. Call 589-1731. Join us again next week for Financial Strategies with Scott Wardell on KMRS, Morris.